Well, good morning, Southern Oregon, and welcome to the Real Estate Show. I'm Alice Lema. I'll be your host today. I'm a broker here in Southern Oregon with John L. Scott Real Estate. Welcome back to the radio show with all things real estate here in Southern Oregon. So we've got Thanksgiving behind us. We've got the Christmas holiday in front of us, and we still have a lot of real estate activity. It used to be that things were kind of seasonally slow in Southern Oregon, or at least slowing down a little bit with our real estate activity. And that isn't really happening much. We still have more and more listings coming on the market. We still have the backlog of buyers that are wanting to still make a purchase. In fact, I think there's even more pressure on buyers now because of the impending interest rate changes. Although we're going to be talking today to Giles and Beth Rodriguez of Mutual of Omaha Mortgage, one of our sponsors. They're going to talk about some of the lending changes that happened this week, and they're huge. They're jaw-dropping huge. So you want to stay tuned in to hear what Giles and Beth Rodriguez of Mutual of Omaha Mortgage have to say about all that. But the reason I'm bringing it up now is because it's adding even more force to the markets. We have people that are in big cities that are trying to get here to Southern Oregon. We have people in Southern Oregon trying to get to other places, in some cases for jobs. Some cases they think that our valley is just too busy now, too many people. People have been here a long time are going someplace smaller. And then we have folks from some of the bigger cities coming here because compared to where they're used to, it's a little slower, little gentler, and definitely more fun to live here. So it's all about perspective, but it's very interesting because in addition to all of that, we have the mid-aged millennials. So the middle range, I should say, shouldn't call them middle-aged, mid-range millennials, kind of in their 30s, late 30s, early 30s, hitting the market with force. They're ready to rock and roll. They're out there. They want to buy. They're buying nicer, bigger homes for their first home than a lot of us older folks did. A lot of us older folks started small, fixer-upper, not these kids, but there's more of them than ever. And that's definitely adding fuel to the fire. So we've got a great show in front of us today. I want you to stay tuned. We're going to be talking to Beth Rodriguez and Giles of Mutual Omaha Mortgage. Do not touch that dial. We have a great show. We'll be right back. Well, welcome back, folks, to the Real Estate Show. I'm Alice Lema, broker John L. Scott here in beautiful but chilly Southern Oregon. And today we are so happy to have our monthly visit by Giles, Mutual Omaha Mortgage, who's also one of our very much appreciated sponsors. Hello, Guy. Welcome back.
Hey, thanks for having me back.
Yeah, well, our listeners love all your good information. So I'm so thankful you come every month. And today you have one of your loan officers with you.
I do. I have the one and only Beth Rodriguez. So
hi, everyone.
Anyway, yeah, I just kind of wanted to introduce her. She's been in the Valley doing loans for a long time. So she's got, I guess I could let you talk a little bit about your experience if you want, as far as I brought her into the business years ago. Yeah. And so anyway, she did a few years with me doing that, and then she jumped off into the escrow side of things and did that for a couple of years, and just really decided that she liked helping people in this way. A little bit more flexible schedule. And anyway, she's just a great resource to have here in the office with her. She speaks fluent Spanish as well as English, obviously. And anyway, so this is Beth.
Well, welcome, Beth. So you're a loan officer at Mutual of Omaha Mortgage.
I am, correct.
Yeah, yes. Tell us a little bit about yourself.
Yeah, so I've lived here in the Valley for going on 16 and a half years about now. So went into lending, did that for a few years. And then, as Guy said, switched over to escrow officer for a while. Did that for about 3 years. Very thankful for that time, just being able to learn the back end of things and how all of that worked was definitely a huge asset for me to have coming back into lending. But for sure decided that I really enjoy the lending side of it better. I just have a lot more hands-on with the clients and get a lot more involved than I was really able to do in escrow. So just definitely be, happy to be back as a lender again and here joining Guy. And the bilingual part in Spanish is also a very good asset to have, much needed for sure as
Oh,
well
yeah.
in the Valley. And so I've been bilingual in Spanish now for, it's been over 30 years now. So
Oh, wow.
not only bilingual, but bicultural, which is very important because I really understand the culture as part of my, family. And so very immersed in that. So it's one thing to be able to speak Spanish, but it's also a whole different thing to be able to understand the culture and their mindset and their thinking. It's just can be some, different aspects. So it's served me well in whatever business that I do. And I'm just really glad to bring that, to be a part of this time in lending.
Well, Beth, and I think you make a really good point, and I think a lot of us don't keep that in mind when we have bilingual people, regardless of the language, when they're helping us or helping our clients. The cultural aspect is huge.
It is.
Yeah, how people deal with each other. Yeah, what means polite and what doesn't.
Yeah.
So, well, we're so excited. How long have you been working with Guy now?
Well, all together, maybe about 3.5 years, I would say. Yeah.
Great. So
Yeah,
the last 3 years have been really interesting in lending, and in even just like the last 3 weeks. So, Guy, what news do you have for us from lending land?
Oh man, as far as that goes, we finally have the official numbers. Everybody was thinking that we were going to end up landing around $625,000 for what are called the conforming loan limits. And again, that's Freddie Mac, Fannie Mae, the big guys that you hear about all the time. That's where most of the loans are. I mean, other than FHA, VA, and maybe some of our more non-traditional loans. It ended up landing at $647,200. So that means if you have, believe it or not, these numbers are going to sound pretty crazy to us, even though we live in kind of a high cost area. That's like $809,000 purchase price if you have 20% down, and you're still in what are called the conforming loan limits. So meaning Fannie Mae.
What does that mean for people who don't know what within conforming loan limits?
So,
what does that mean exactly?
So they've always been kind of, there's been a relationship between the government and Fannie Mae and Freddie Mac. They're these big companies that write pretty much the rules for the loans and how they're done. After the crash in 2009, the government kind of came in and took over. The CFPB went in and anyway, just kind of took over these two institutions. And so instead of being something that was just kind of semi-ran by the government, they're basically taken over by the government. Whether that's good or bad, try to leave politics out of it. I think a mixture is probably good. We don't want such loose lending that, that we're just loaning to anybody that'll fog a mirror. And at the same time, we want to have the markets, decide a little bit on which direction we're going. So those are just, it's the majority of the loans that are backed by them. And that's pretty much what all of the lenders out there are originating. So you can go higher than that, but it's just, you're going to get the best deal if we can stick you into one of those programs. So that still means if you did, 5% down, as long as your loan amount is at $647,200 or under, you're still subject to all of the same conforming guidelines. So it's basically a normal loan went up just under $100,000 in 2022.
So am I understanding that a conventional mortgage borrower can now have a mortgage of 600 and what did you say?
47,000
with a 5% down. So they'd be buying what, like 7 something. So yeah. I just want to make sure I understand. So we can be writing offers in the 700s with 5% down on a regular 30-year fixed conventional. Is that what you're saying?
Yeah. Yes.
So that's mind-boggling and a game changer.
Yeah, no, it really is. And it was kind of a well-needed, thing here. If you're talking about a place in the middle of the country that the median house price is $120,000, it's a little bit different, so I mean, it's kind of weird that there's just this one all the way across, but for our area, it was absolutely needed. So it adds a lot of flexibility,
So this is instead of doing a jumbo loan?
Correct. Yes.
Wow.
Yeah. Yeah.
That really is mind-boggling. We'll have to let that soak in.
I know, and I'll just keep mentioning the number every week
because people are gonna say that again, because 600 and what?
47,000.
647,000. Wow. So Beth, have you had any phone calls with people wanting to get qualified for that? And do you think there'll be more groups of people, like more than one family member coming together to meet that loan amount? 645,000? Wow.
647,000.
47, excuse me.
Yeah, so that just rolled out. I've just, been starting to tell my agents I work with, partner with, and let them know. So no calls as of yet. It just came out. So I'm definitely excited to get the word out, though.
So how will you get the word out, and how do you explain this to people?
Well, I mean, at least from my standpoint is, I mean, I think it does fit into and speak to what you're talking about. I have some people right now that actually are buying a Hayden home that has 2 master suites in the thing, and they're going to end up father and mom, and then the son and daughter-in-law. They're realizing that the parents are going to need a little bit of help down the road. They're perfectly fine right now, but it's like, why not be together, go in on a house that's a little bit more expensive, and have yourself set up for the next 20, 30 years as far as that goes. So we are starting to see the multi-generational, and this could speak to that, pretty well, and at least address, some of the housing concerns that people have, because it's expensive for one family to buy a house right.
Yeah, I was gonna say, actually, I wonder if you run the numbers, if it's less expensive to do a group purchase, have another family member or 2 buying a single property. Plus, then you don't have 2 people fighting for 2 houses.
It's true, and in the right circumstances, it's good. I'm not always a huge fan of pulling your money together with somebody that's not immediate family, just because life happens, and if one person wants to move on,
then there's that.
Then all of a sudden one person wants to sell and the other person doesn't. So I mean, it could pose some issues with that also. So it's not always a one size fits all. That's why we really like to dig down and find out what people's goals are, so we can get them into the right program. I've had people that realistically weren't going to be a year before they're going to pay off their house. Well, I don't want to, is the lowest rate the most important thing at that point? Maybe a cheaper loan at that point. And then that way we can look at redoing you, or, you're going to sell, or you're going to pay it off. So it's just a math problem at that point. So we like to just individually get people into whichever program's the best one.
Well, and to be able to offer that new conventional financing loan, where the loan amount is, what'd you say, Beth?
647,200.
So, and then you have your down payment on top of that. So, but you could do a 5% 30-year conventional mortgage. It doesn't have to be 20%. It doesn't have to be a jumbo. And that's what happened this week. Is that what you're saying?
Correct.
Yeah.
And is that nationwide or just our area?
It's our area. I mean, it's nationwide. So what they have is they have high cost areas that are, like, say, San Francisco or New York, and those conforming loan limits in those places are the same, but they have kind of a high cost area. So they might go up to $1 million for a conforming loan in some of these really high cost areas. But the vast majority of the country, I would say 96%. I can actually send you a map that you can maybe put up on this thing, but probably 97-98% of the whole country, this is the conforming loan limit at the 647 too.
Wow.
So that's what I was kind of going to earlier, where, if you're in a cheap place down in, someplace down in Tennessee, it might, may not be warranted to have a price this high. But for a lot of the country, for us, Sacramento, places like that aren't the real high cost areas, it's going to end up being a really good benefit.
Yeah. Well, and also acknowledges that Southern Oregon is pricey.
Yes. Yeah. Yeah. So, I mean, and it's just good, because if you can keep people into this sort of a deal, it's going to be a lot better one than having to go off into the jumbo land. Usually, they've actually had some pretty good rates on jumbo loans recently, and that's any dollar amount over where Fannie Mae and Freddie Mac are allowed to purchase them. But it's going to end up putting it at about $680,000. I'd have to do the math on it, but just kind of in my head, with 5% down, that would put you up to about a 680.
I just can't believe it.
Yeah,
Wow.
No, it's going to be a good thing. So,
yeah. Well, we're going to have to take a quick break here coming up. We're talking to Guy Giles and Beth Rodriguez, Mutual of Omaha Mortgage, talking about the new loan limits put out by who put it out?
the FHFA. So
the FHA. So do not touch that dial. We'll be right back with more updates. Well, hi, folks. Welcome back to the Real Estate Show. I'm Alice Lema. I'm your host today. I'm a broker here in Southern Oregon with Giles Scott, and we're having just kind of a jaw-dropping conversation with Beth Rodriguez and Guy Giles of Mutual Omaha Mortgage, who are also one of our sponsors. And they just brought to light some new loan limit changes for our area, well over $600,000 for a conventional mortgage with 5% down. So folks, let that sink in. That is a real game changer, but it's kind of badly needed, isn't it, Beth?
Yeah, definitely.
So
Be a big help.
to piggyback with that, I mean, they will still do a 3% down, believe it or not. So there's
really a 3% conventional.
Yes. Yeah.
So how does that work?
Well, it's just the mortgage insurance is a little bit higher on it. Mortgage insurance is one of those things that was a one size fits all deal up until just a couple of years ago, and then they really started driving it a little bit more like you would on a credit card or a mortgage loan, where it's more credit score driven. So if you have I've had people with $20 mortgage insurance, not on 3% down, but it's just kind of a sliding scale. So if you're at 20% down, you don't have mortgage insurance at all. If you're at 19% down, you'll have really cheap mortgage insurance. If you're at 3% down, it's going to be a little bit more expensive. It's just
right, because what they're trying to get to that 20%. So
yeah,
right, isn't that the cutoff?
Yeah. I mean, if you're able to do that, a lot of people just that's a lot of money to come up with to have 20% down. So we'll just sit down with people. If we can get them into more of a conventional loan, the mortgage insurance will go away at some point. So that's why it's nice when rates are still low like they are right now. If we can get people into the right deal, then they're not thinking, well, I'm just going to have to refinance in 3 years or 5 years or 7 years, whenever that mortgage insurance is done. There's still a lot of ways to have it a little bit cheaper, or get rid of it with an appraisal before that time.
Well, and also, how do you know, as a buyer, a borrower, how do you know that in 3 years you're going to be able to refinance? I mean, we all assume that our jobs are going to get better and this and that and the other thing, but
it's true. We saw lending tighten up a lot. We saw, a lot of changes happen after that last crash, and a lot of people were blindsided by it. So it's true. And even if you still have your job and everything's fine, but we had, inflation stayed kind of hot like it is right now, rates just might be up. So then there's not going to be any benefit to doing that anyway. So we're definitely not a big proponent of, let's just get you into a loan and then refinance you in a few months.
Yeah, I think definitely the important thing is really being honest and upfront with our clients and letting them know, what that future might hold and the what ifs, and not just let's fast and do this to get it done. But as Guy was saying, what are their goals? What's the best for them? And to give them all of the information so then they can make a good educated decision is definitely something we stand by.
Yeah, that's awesome. Then they can kind of decide because, the FHA program is amazing and I'm not bashing it. I don't want anybody to get the wrong idea because there's some times when that is the appropriate program, but and it wasn't that long ago that FHA stopped letting you drop the mortgage insurance. And so now the only way you can have it dropped without refinancing is being in a conventional loan, right?
Correct.
Or
Yeah.
you're a VA and you don't have mortgage insurance.
Yeah, I mean, and if you have a bigger down payment, you can get rid of the mortgage insurance at some point on an FHA. But if you have a bigger down payment, then you might as well go into something conventional.
Oh, I didn't know you could do that.
Yeah, just depending on the down payment. But I think one thing to maybe ask Beth here is, just say somebody was coming in to meet with you, what kind of things would you like to have them have with them, to be ready to go to actually do the whole pre-approval process with you?
As far as documentation.
Yeah.
Yeah, so basically, it's not a huge long list at the get-go, so it's not very daunting, but just their IDs, making sure that everything is good on that end, status, legal status, that sort of thing is always important. And then basically just the last 2 years of tax returns, W-2s, and last 30-day pay stubs from their job, if they're self-employed, then those tax returns. And the last 2 months bank statements of any account that they would be using for those loan purposes.
And those are looked at just to make sure that they're not getting in over their head and that everything's accounted for, right? It's not just being Snoopy, nosy
Exactly.
Snoopy.
Yeah, a lot of people are like, well, I did the whole, online thing with X company and they didn't ask for anything. Well, that's all great and good, but that doesn't mean they're not going to get asked for those things down the road. So,
well, it was probably also in 2005. Nobody cared.
Well, you'd be surprised though, even today.
Yeah.
That way, it's so important because we've actually looked at their credit documentation and we're basing it off of their information and the credit pull. So it's going to be, a stronger case where we're not just in the dark, not really knowing, it's not going by just what they state, but actually taking a look at those things. So we can, say comfortably that, yes, it looks like you are able to do a loan. So
see, and that's good for the consumer and that protects them. And that's what we were missing before the crash, and that fed the crash. And then after it unwinded, the lending standards are so different. So when people are sitting with you, Beth, and getting pre-qualified, are any of these buyers asking you about the market, if there's going to be another crash? Do you get much of that?
I get a ton of that, actually.
Yeah, people don't understand the lending practices are so different now.
Yeah, I definitely get that question a lot, and they really, want that advice and that input. And what's the market going to do? Is it going to crash? Should I wait to buy? Is now a good time to buy? And so again, it's just really, circling them back to what are their goals? Because for one family, it might be actually this is a great time for them, and another it might be better to hold off. It just depends on what their more long-term goals are. So by giving them the full picture and all of the information and all of the options, it really can make a big difference in them feeling comfortable whether they want to go ahead and go forward with the process now, or maybe just wait a little bit. So we definitely just try to educate them and give them all of the information that we have. And again, that just helps them make a more comfortable decision, so they actually know the facts and can go forward at that.
And that's definitely a reputation Giles has always had, education, choices, doing a good deal. But it's that neighbor thing when you live in a small town, right, Guy? It's like what did you call it at Costco? Something about throwing somebody at you?
Well, kind of like my canned soup theory, I don't want to throw
soup
at me at the store or something. So, it's just a little different when you're trying to deal local, and when they ask us too many questions about what the market's going to do, that's why we love to have a good realtor like you on the other side. So we can say, we're not going to say anything to that, to Alice, but I'll bet that she'll probably kind of reaffirm the same thing that, nobody has a crystal ball, but there's just a finite amount of houses in this area. And if you can own one, it's probably not going to be a bad thing for the long term.
Well, and look at the people who bought something just 18 months ago.
Yes.
So much equity.
Thirty to
can't-
$50,000 in equity, just boom, literally almost overnight.
I will get a phone call from somebody and it's like, we want to buy a new house. And I'm just like, well, didn't you just get into your house on Friday? They're like, no, it's been a year ago and I have 120,000 equity and we want to move up. And
Yeah.
it blows me away every time.
Yeah, but I gotta say, for our Southern Oregonians, because our economy is not always stellar here, I am so happy for all those people because homeownership is a beautiful thing, and that was just like money from the sky, and now they can move up into a bigger house or whatever they need to do. So I'm just really happy for our locals because it doesn't
Yeah,
always
no.
go that way, right?
Not at all. And I think the other part is just realizing it's a longer game, you know. I mean, if you're gonna try to play Mr. or Mrs. 2010 and buy something that's a foreclosure and fix it up and flip it, you know, that's just not really a thing right now like it was back then.
Yeah.
You know,
Yeah.
everybody needs a house and, you know, go into it. Just, I mean, it's part of your portfolio. You know, you have a 401k you're investing in. You know, if you have a house as a piece of that, it's just a really good wealth builder and just more of a more rounded portfolio.
So how many investors, like landlord people, are you getting right now that want to purchase more properties?
You've had quite a few lately, it seemed like. We've been talking about a deal or two.
Yeah, definitely. There's been an uptick in that. More investors looking for properties and sure.
Do you see any trends forming? Any common, like what kind of properties they're looking for? Why they're picking now?
For me, it's been either just the, single family, just one unit. Sometimes there has been the 2 to 4 units, duplexes. I think why looking now, rates just still being good. Just opportunity and.
Well, I was just gonna say, we had a little bit of a scare there for a while. They came back and were charging a lot of money, basically saying that you could only have 7% of your portfolio being an investment property as a bank or as, as a servicer. So everybody was really leery.
So they're talking about you guys.
Yes, but so they were really, really expensive to do any kind of investment properties for a few months this year. They actually backed off on that now, so it is starting to become a little bit more attractive. I'm dealing with 3 kids right now that none of them own a primary residence and they're all 22 to 25.
Oh, I love
Really-
it. And they're
really
buying
successful
rentals?
jobs. Yeah, one of them's got about probably 9 doors now. We've done all of this investment properties. They have tightened up a little bit where they want you to own a primary residence before you buy an investment property.
Why would they
But-
care?
Oh,
Why would the bank care?
That's the question, Alice.
Is that the
Yeah,
wrong question to ask?
You told me not to get political, kiddo.
Oh,
I'm
all
gonna-
right. Well, there's
Um,
got to be economic factors as well.
I don't know that it's economics as much as everybody should deserve no more than one house. There you go. I went political.
Oh my goodness, that's
So-
terrible.
That's the conspiracy theorist in me. The other part is, well, I can't think of another explanation. So there we are.
All right, well,
but-
moving on. So these kids that are buying properties and being landlords, they're doing this in Oregon? Yeah, are they here in Southern Oregon?
They're from here.
They're from here. Okay.
Yeah. So 2 of them are from here. They live in Boulder, Colorado right now, and so they're actually moving back home to be closer to family again. But one of them's down in the California area. So
Wow.
there's actually 4 altogether.
Wow.
And they
Good for
love
them. So
buying.
those are the millennials, the young millennials?
Yeah.
Yay.
No, it's they're a great group. And anyway, their business is successful and they're running it all remotely. And anyway, it's been anyway.
Those kids are so smart. They are so smart. Growing up with the in the digital age, I don't know what it's like when they walk into your office, but when I meet them, they're just so informed and so ready to go. It's really fun. And can you imagine buying houses when you were in your early 20s? Or maybe you did. I didn't, but
I didn't.
Well, when you accidentally said building them, yes, I was a hod carrier for a mason. So I built lots of them, but no, I didn't even think I'd ever own one, to be honest.
yeah. Wow.
But
So that's an interesting trend to look forward to then. And I know I don't know if it was CoreLogic or KCM. One of those reports came out this week talking about the older millennials were really starting to come out in force to be purchasing, and it was the biggest demographic group in forever, was like right now. And this idea of the market slowing down, because we see prices softening as we get more inventory, but the demand is there. And then they made this prediction this week that the demand is going to increase the 2022. What do you guys think of that?
Well, I mean, it's funny because Fannie Mae said that it's only supposed to go up about 7% this year. But then if you go back, Goldman Sachs is talking 17%.
Right.
So,
And that those
look,
two predictions are not that far apart time-wise.
no. So I think that I think it still goes up. And I mean, as they loosen up on the mandates, people are able to work remotely, and companies are realizing to keep good talent, they have to let them be a little bit more flexible with their time. And I think it's just going to make places like this more and more attractive all the time.
Yep, I think so too. Well, we've got to take another break. So hang on, folks. Do not touch that dial. Beth Rodriguez, Giles, Mutual Omaha Mortgage. We'll be right back. Well, welcome back, folks. We're here with Beth Rodriguez and Giles, Mutual Omaha Mortgage. I'm Alice Lema, broker John L. Scott here in Southern Oregon. And this is our monthly update from the Mutual Omaha Mortgage team. And it's very interesting. We were just talking before the break about the surge of millennial people that are buying houses, and that some of them are buying investment property. But that's interesting, because the first time home buyer mentality is unique. There's just really no other buyer like a first timer. So Beth, just wanted to ask you, like, how can people get ready, and what should they do and not do if they think they might want to consider buying a house or a property?
Yeah, we're definitely just so big on educating them and giving them the correct information, because a lot of times they're getting from what friends and family maybe information that isn't quite correct. So the good thing is to even just start early, come in and talk to us. Not per se, maybe we're going to just pull your credit on the first step just to see where they're at, but to really educate them on what they can do to prepare their credit. A really good thing that we tell them is just having that credit karma is good, to be able to it's not going to be totally accurate, but the best thing it's for is just to show them if their score is going up or down, but to be able to really make sure that their credit is in a good place.
But what is a good place? Like, define good place.
Well, just making sure there's no judgments, no collections, having high limits, high balances. They're going to have their limit. They're really close to that limit. It can be a negative thing. So really keeping those balances low.
I mean, like on the credit cards?
Yeah, on the credit cards. Yeah, thank you. And also just being really careful. A lot of the places, stores will say, hey, if you sign up for this card, you don't have to use it, but you'll get the 20% off and we'll just cancel it. So those types of things, of having them realize what does affect their credit, is so important, just to really protect, not having anybody and everybody checking that, keeping their balances low. Another thing is, it just left me. I was going to say super important.
Well, and I didn't know that those discount cards, like at the retail stores, would affect your credit.
Yeah.
Well, if people are pulling it.
Yeah.
So
anytime somebody pulls your credit to extend your credit, that's considered the hard pull, and it is going to affect.
But when you guys do a credit check, it doesn't really hurt somebody's. When you do it, it doesn't hurt their credit score, right?
If it gets pulled a bunch, I mean, it can go down a couple of points as far as that goes. So, but it's better to just take a look at it and make sure that there's nothing to address later on down the road. Because we have had people that had a phone bill that, that they've had, that they thought they took care of 5 years ago, and they're just really not taking a look at their credit at all. And now it's something that we either have to address or don't have to address. Sometimes it's an old wound that's mostly healed up. So it's just good to be able for us to take a look at that and just kind of analyze it and see, maybe what should be addressed or what shouldn't be addressed. And sometimes you'll get somebody. I had a lady in here that was 37 years old that was a ghost, no credit score at all, just a week and a half ago. And then that posed a little bit of different challenges as far as putting her into a loan program.
So how like they didn't have utilities or credit cards or anything?
Yeah, she was a ghost. She had nothing. And she'd been married to a guy and he had a perfectly good credit score. They've been married the whole time, and just somehow they didn't even realize that it was happening over the years, that she just didn't put herself on things. And it was kind of crazy, but it was something that we addressed before they found a house. So, we were able to come up with some, a plan. But anyway, it's just good. The time to try to work on your credit is not in the middle of a deal.
Right.
Yeah.
So
and late payments. I remember that the other thing that I was going to say, a lot of, especially maybe some of the younger generation, not realizing that even just one 30-day late payment just makes a huge hit.
oh yeah, you can't be late. But we also, even if you have some lates, we still want you to come in and talk to you guys. So with that in mind, how early in the process can a person come in and just start getting some education in the process? How early would be too early, for example?
When they start thinking about it, and like I say, even if they're like, what, I'm graduating college in a year from now, then we can just kind of talk to them. We don't have to pull your credit at that point, but we can just kind of talk about what your rent is right now, and that's a nice thing to say. I've had people literally come in that want to buy a $400,000 house. And when I dig a little bit deeper, what's a comfortable payment for you? $750. How much do you have saved? I don't know. It's going to depend on what I get back on my taxes. And then you go in to like what she was saying, and you have a whole bunch of maxed out credit cards. You're like, your rent is only $750. And I mean, I'm not here to judge somebody or tell somebody whatever, but as an advisor, it's maybe a good conversation to say, you might want to try on a $1,500 mortgage. Just pay yourself that difference for a few months while you're thinking.
Oh, that's a brilliant idea.
A, you're saving money, and B, you're not in that already. So I mean, it's just a good way to try it on. And at the end of it, it might be, $1,700 wouldn't be bad, or I really need to stick lower. So.
And there's nothing wrong with coming in early, right? Sorry, Beth.
No, not at all. And we're always happy to answer questions. And, kind of the sooner people can prepare, the better off they're going to be when they are ready and get ready, quicker, when they know the right things to do. And so I was just going to say, I learned that from Guy, and I use it with all of my clients is, what are you paying for rent, and start paying yourself what you think that comfortable payment is. And I know a lot of my clients have done so, and it's really served them well.
That is such a good idea. Then there's no stress. The other thing is, it's okay to go and talk to you and find out that you're not ready. It's like that's the perfect time to come, right?
Yeah, exactly.
Because you get a list, and then you know what to do, like you just said, the right thing to do.
Correct. And I've had clients that I spoke to a year and a half ago, and then they've come back ready. And then so we can get them into something. So it's just helping us, and it's helping them, and it's just a good situation.
Well, and you put them on track with the right list of things in the right order to fix or change. And sometimes they get from their friends and family or social media the wrong information, and they go and do those things only to find out it didn't help at all.
Yeah.
Whoops, we lost our audio there.
Oh,
there we are. You're back.
Sorry, I got a phone call. I don't know how to mute that out.
Sorry, folks, we're still working remotely.
I had a guy that owed like $30 on an old Sprint bill or something. I don't even know if Sprint's the thing anymore, but literally I said, well, hey, why don't you pay that thing off? I was new to the mortgage industry. This was a lot of years ago. And he said, anyway, I talked him into paying it off, dropped his credit score 20 points because it was an old wound that was completely healed up. And this was just one of these things that could have been information from his buddy saying, well, if you owe that, it would only make sense that your credit score would go up if you paid it off. So it's good for us that have looked at a lot of credit reports. We're not a credit repair place at all, but we've looked at enough of them that we can, just kind of guide.
Yeah. Well, Beth Rodriguez and Guy Giles, each of Omaha Mortgage. If somebody wants to get a hold of you to get some lending advice, how can they find you?
Well,
Your phone number?
my phone number, my cell number, they can call is 541-292-1477 would be.
Let's do that one more time.
541-292-1477. And I just want to tell first-time homebuyers especially, no question is dumb. So always feel comfortable asking a lot of questions. The more questions, the better.
Perfect. Thank you, Beth Rodriguez, Guy Giles. Thank you, folks. We'll talk to you next week. Have a beautiful Southern Oregon weekend. Bye now.